So this part is called intermarket analysis, right? So is the only part that we are using fundamentals, right? So if somebody will ask you, do you use fundamentals? You say yes, indirectly, we are using them, right? My question is clear. Yeah. If you see Dow and Standard & Poor's 500 collapsing, what do you think that's going to happen with your market? When I say collapsing, I mean panic, right? Yeah. Not just drop, let's say, 500 points. Will be affected. So then, do you think that SAPIC will be affected also?
Well, the way we see it here is we are correlated with the international markets, and if the Dow collapses, like you're saying, it will affect our markets here.
Okay. All right. Good. But there is a relationship.
Yes, there is.
Okay. We don't know exactly why, but we are talking about a village now. Okay, a global village, right? So when there is panic in the United States, it's going to be in Europe, it's going to be in China, it's going to be in Oman too, right? Do you understand what I mean? Because we all follow all those stuff. So how about the ruble then? What's going to happen if the stocks will collapse and the oil is going to go down? What do you think that's going to happen with the ruble? It's going to go up, right? So everybody of you, even if you just trade the currencies or just trade the local markets or just trade like whatever you trade, right? So you should know once a month what the hell is going on or what may happen. You understand what I mean? So, and you have to be correct, right? Or you have to base your opinion on something. So for me, it's safer and the best way to have an opinion is to use the charts, right? So, but still, you can use a little bit fundamentals, a combination with them, and all this stuff. Okay? This is called business cycle, right? So let's suppose that we are at the top, and this, the blue one, are the interest rates, right? Or we can say bonds. So, or we can say the futures of the bonds. So who can tell me the correlation between the interest rates and the bonds? That means if the interest rates are going up, what is happening with the bond price? No, going down. The bonds are going down, right? The price of the bonds are going down, right? So that means if we increase the interest rates, the price of the bonds are going down, right? So that means the future price of the bonds, right, it also is going down, right? So that means when I draw this one, right, I mean the price of the bonds. Or the analysis that we made before about the 10-year bond, okay, the treasury bond, all right? So that means this is the curve, all right, the line of the bonds, of the price of the bonds. So of course we have here, as coming a little bit later, we have the stocks, the 500 and so on. So and then we have the price of the commodities. So as I draw here, and we are talking about this point today, let's say. So I mean that the bonds started already to go down. So the stocks started to go down. And now they just start to go down, the red one, which are the commodities prices. So the red one are the commodities, right? And let's see the logic behind this. So if the stocks are going down, means that we don't need we don't need raw materials to produce more, right? Because if the stocks are going down, we forecast that we are not going to have that much production, right? So that means we don't need so many raw materials. That means the commodities will go down. Do you understand this part? Stocks are going down, the commodities have to go down. So now they just flattening and they start going down, all right? This is my chart, okay? So what is happening if we are at the bottom of the market? Okay? So the logic is this one. The price of the bonds has to move up, and then the stocks will go up, and then the commodities will go up. All right? Let's see the correlation. If we are here everything is perfect. The commodities are going up, the stocks are going up, and the bonds are the price of the bonds is going down. The future price of the bonds is going up. So can we forecast that the next step is this one and we are very close to this one? How do I know that that's it? The bankers will, the central bank will increase the interest rates. How can I know this?
Contrarian.
Good. If we check the bonds and we see that they are contrarian up, means that they will increase the interest rates. That means it's going to go down, the price of the bonds will go down. That means the interest rates will be raised. Do you understand what I mean? All right. So now, if I check the bonds, the bond price, to forecast what's going to happen with the commodities and the stocks, that's smart, right? So, and then you have a tool here that you can forecast what's going to happen in 6 months. So again, if we increase the interest rates, the stocks will go down. If the stocks are going down, the commodities are going down. Is it okay now? Right. So I check the price of the 10-year bond price for the Americans. Okay? So in this one, the bond is a 10-year bond, right, for Germany. Right? I can check those two, and then I'm going to have a result here. All right? So not for now. Don't check it now. But the idea is that I start from the bonds. I make an analysis once a month on a monthly, weekly chart for the T-notes and the bond. Right? That's so simple. How much time do you need to make the monthly and weekly?
26 minutes.
26 minutes. In 26 minutes, and if you practice a little bit more, the 12th month is going to be 10 minutes. Right? So if you know that we are here now and the bankers must increase the interest rates, then you can forecast what's going to happen with the stocks. You can forecast what's going to happen with the oil. Do you understand what I mean?